Inflation is a hot topic right now in the US, though it is being felt elsewhere as well. A lot of this stems from that since the outbreak of the coronavirus pandemic from the beginning of 2020, the United States government has come out with multiple forms of stimulus. On the fiscal side, there have been multiple stimulus checks sent to American households, and the increasing and extension of unemployment benefits for affected workers. On the monetary side, the Federal Reserve quickly dropped the target Fed funds rate to near 0% once again, and started a large and rapid campaign of money printing by purchasing bonds and mortgage-backed securities, among other things. One notable statistic is the explosion in the N1 money supply, which is an important economic metric that the Federal Reserve and other institutions track. As we can see here, it has gone up by multiple times, starting at something around $4 trillion just before the pandemic really took hold in the United States, to nearly 18, 19 trillion or so today. And this is from the official Federal Reserve statistics. So in the face of a potential steep rise in inflation, which is arguably already being felt in multiple areas of the economy, how can one protect oneself? Here are a few asset classes which are touted to or historically helped protect against inflation. Precious metals such as gold and silver have long been valued and coveted and have been used as and considered money for almost all of recorded human history. The performance of this asset class has also typically provided protection against inflation. For example, after the Nixon administration closed the gold window in 1971, gold rapidly appreciated in price in dollar terms, showing volatility throughout the 70s and peaking at over $800 an ounce. More recently, in the decade of the Great Financial Crisis, gold made a run from less than $300 per ounce around the beginning of the century to peak at almost $1,900 per ounce amidst the government stimulus and money printing after the crash of 08-09. More recently, gold and silver have been on the rise again, and seem to have captured their previous highs in the 2011-2012 timeframe. Currently, gold sits at just shy of $1,900 an ounce, and silver at over $25. Another asset class to consider in fighting inflation would be real estate. Right now, there is a rush to purchase homes by many people throughout the United States, leading to rapid run-ups of home prices in a number of areas in the U.S. There is more than one way to allocate part of your portfolio to this sector. Rather than buying properties directly, you may want to consider REITs, which stands for Real Estate Investment Trusts, giving you indirect ownership of real estate of various types and indirect exposure to this sector. Another way to go is to load up on strong, recognizable companies by purchasing shares of their equity, as those with proven business models are likely to be flocked to by some investors seeking to hedge against inflation. Companies with earnings and pricing power are particularly important, as in the face of inflation they will likely increase their prices in response to rising input costs and other factors. In this category, it is best to focus on companies that own tangible, productive assets, such as industrial, agricultural, or other types of companies that provide necessary, important goods for consumers. A relatively new and interesting asset class that might offer protection against inflation would be cryptocurrencies. All else equal, if there are more dollars in circulation, then this would potentially put upward pressure on the nominal prices of crypto assets. It would be best to ensure that you are looking at cryptocurrencies with fixed or relatively fixed supplies, meaning that, unlike a fiat currency, there is a hard cap or some kind of other limit to how many of each of the tokens can exist, such as Bitcoin's maximum possible float of 21 million coins. However, cryptocurrencies are difficult to value as, unlike stocks, they do not represent tangible physical businesses with products, services, employees, and the like. So be sure to educate yourself on how to compare different crypto assets and what the technology holds so you can figure out which ones have merit and which ones don't. Another kind of potential inflation hedge you may have heard of are called TIPS, or Treasury Inflation Protected Securities. Similar to bonds, these are a type of U.S. Treasury bond indexed to inflation in order to explicitly protect investors from inflation. That means that the payout or yield, meaning the principal value of the security, is adjusted upwards to account for inflation as measured by the government. Twice a year, TIPS pay out a fixed interest rate to the bondholder, which would be you if you were to purchase TIPS. However, TIPS being a reliable protection against inflation relies on the government's measure of inflation being accurate. Thus, if you are skeptical of the government's reporting of inflation figures, such as their measure of the CPI or Consumer Price Index, then you might not find TIPS to be a tenable solution against inflation. I encourage you to educate yourself on what inflation is, how it occurs, and to research more on how to protect yourself from the possible loss of value of your nation's currency. And thank you for watching the video. If you like the content here, please subscribe, hit the like button. Check out my other videos. I cover individual companies and I cover other concepts. You can check my channel and look at the links in the description for other general educational videos. Thank you and take care.